For any developing country committed to building roads, schools, or hospitals, one fundamental question remains: where does the money come from? Financing development requires massive capital, sourced both globally and locally. Today, the single largest source of external capital for developing nations is private money, specifically in the form of a foreign direct investment or FDI. An FDI is a large scale investment made by a company or investor from one country into business interests in another. This isn't just a stock purchase, it's a direct stake, often involving building factories, setting up logistic hubs, or acquiring local companies. Now, why does this matter? FDIs are highly valued because it doesn't just bring in money, it brings in technology, management, and expertise, along with job creation. When a multinational corporation builds a solar panel factory in Vietnam, that's FDI, and it boosts the local economy's long term productivity. Developing countries often require loans from international organizations to fund major infrastructure projects or stabilize their economies. The primary sources of these loans are the World Bank and the International Monetary Fund, or IMF. The World Bank focuses on funding long term development projects like dams or educational programs, while the IMF focuses on providing short term stability in countries facing a financial crisis. Another option are loans and grants, which can come directly from developed countries, and these are known as bilateral aid. However, these large loans often come with strict conditions through structural adjustment programs or SAPs. These are economic policy reforms required by the IMF and World Bank in return for the loans. They typically mandate cuts to government spending, privatization of state owned industries, and the removal of trade barriers. Proponents argue SAPs enforce fiscal responsibility, while critics argue that they impose unnecessarily on already poor populations by forcing cuts to vital social services like healthcare and education. While FDI and major loans focus on national budgets, microfinance addresses the capital needs of individuals at a grassroots level. Microfinance is the provision of small scale financial services, primarily small loans or microcredit, to low income individuals who lack the collateral or credit history required by traditional banks. Now, these small loans, sometimes as low as $50, are given mainly to women to start tiny businesses like selling food or weaving textiles. Microfinance is highly effective because it directly empowers the most marginalized, leading to higher loan repayment rates than traditional loans, providing a vital route out of poverty. For billions in FDI to small microloans, and through the complex machinery of international banks, the financing of development remains a constant balance between mobilizing massive capital and ensuring that money creates sustainable growth for all citizens.